Okay, I wanted to do a real quick video to answer JM Trader here. He had a great question and a great place for you new people to start, where to get your head on straight, and let's be realistic on what you're doing here. Okay. Now, if you've been to this forum before, this is going to be old news, but sometimes repetition is the mother of all learning, and I started this just to help new people because once you get these basics, you can do whatever you want. You probably won't come here; it'll be boring to you. But here's the thing: are you here to be excited, or are you here to to learn how to make money? Making money should be boring. You know why? Because if you do the right thing over and over again, it's fun, but it shouldn't task your brain too much. It should be boring because you're sticking to concrete principles. All right, so JM Trader, what do you do basically? He knows what to do when high volatility, but what do you do when a low IV market? And if you read my response, basically look for something with high IV rank or don't trade at all. Okay? Why? Because like you're the casino this time, right? Because you're selling the premium, you're selling it to other people. You only want to sell it when the odds. You only want to play when their odds are in your favor. Okay? So for example, let's look at the SPY chart here. All right? And I'm going to go back let's go back. I'll go 5 years real quick, but then I'm going to zoom into just the last year. Hold on. Let me zoom out real quick, and I'm going to go just from 2013 to 2014. All right? I'm going to go like that. Right? And it's going to load. And you're going to see what I mean by only playing when IV rank is high. So if you want to trade if you don't want to just trade SPY and you're looking for a different stuff to trade, here's what I would do. Go to the Dole grid page, all right? And I would stick to, there's a couple lists. You can go to, notable stocks, all right? Because these are anything with high IV rank. You're going to click on this filter. You want to exclude earnings, okay? And you want to drag this down to like 55 days, 56 days. And you want IV rank to be 50 or greater. Okay? But the problem with this list is, and you want to, volatility, you want it arrow pointing down because you're in descending order. See this? The problem with this is not all of these are going to be liquid. Okay? Meaning the bid ask spread might not be completely narrow enough for you. So what I probably want to do is, see this, if you're starting off, see this tasty trade list? These are the ones Tom and Tony trade all the time. So if you click on that and you keep the same filters on, like this, you will see these are the ones they trade, and they usually all have great liquidity. So if the one you're trading isn't, look for something here that is. But you also got to watch out for earnings on this other stuff. I prefer you stay with ETFs if you're beginning because it's safer. But hey, it's your money. Do whatever you want. All right? But if you're just trading the SPY, which is what Karen does, actually it's SPX, look, here's your IV rank chart. As you can see, IV rank is 70. But as you see what I wrote in my reply to him, let's count how many times IV rank got above 50 last year. All right? I don't care if it just touches it. Let's see how many times it got above 50. 50 or above. Once. Right? Twice. 3, 4, 5, 6, 7, 8, 9, 10. I don't think that counts. I don't think that one counts. Only 11 times last year. And if you sold a put credit spread, one standard deviation below or half of a golden gecko on the put side, you would have won 100% of the time, and you would have made money 100% of the time. And you probably would have beat the return on the SP 500. Okay? The SP 500 only returned like, I don't know, 13.8, I forgot here. In 2014, it only did 13.46. Year to date, it's down 2.96. You'd be up year to date. Okay, now get this now. 2014, for the stuff we do, was one of the hardest years ever to do what we do. Okay, so this year has been freaking great. I'll show you why in a minute. Here's why. Take a look. Every time this thing got up IV rank, got above 50. Okay, look, it did that on January 23rd, right? Look how long it takes for IV rank to go below 50. Remember now, you're betting that You're selling high, buying low. What that means is you're selling when IB rank is high and you're going to buy it back when it drops below 50. So let's count how many days it took, right? On January 23rd, it went above 50. Look how long it took to get way below 50. Less than what? I don't know, 10 days or something? Trading days or trading days. And look what happened to the price on this date. It got right back to the same place. Well, it got right back to the same spot where you sold it. That's the golden gecko because you're betting it'll stay below a certain price and above a certain price. But if you're just selling puts, you're just betting. You were betting that it would stay above a certain price down here, and sure enough, it did. And IB rank dropped, and you made money. Look, every time it did that, you made money. Every single time you sold it, you bet it would go higher. It made money every single time. Not once would you have lost. See, look what happened here. It dropped right all the way down to here, but you're selling. You're not betting. You're betting it'll be low. It'll be low like somewhere up here. Look, it always came back up. Okay? Always came back up and IB rank dropped. Look, even over here. Okay? The only time you got tested was right here. Okay? IB rank got to 50. You would have sold it, right? Sold a 84% or 1 standard deviation below. And it dropped way below that, right? And IB rank dropped to 100. What do? Well, first of all, this option you sold doesn't expire till here. So you had plenty time to get it back, right? Now, what do most people do? They put on more positions. Because when IB rank gets to 100, especially when it gets to 100, it can't go any higher. It has to collapse, right? So you're selling puts all the way down, and look what happened. Let's look at the days it took, all right? From 50, okay, it shot up to, so 10-8. It took from October 8th to October 20th. What is that? 12 days to get to 12 days to get back up for IB rank to collapse, and for this to get right back up within that 1 standard deviation rate, you would have made money, a hell of a lot of money. All right, that's why. Now, it only happened 11 times. Look what's going on now. All right, so I'm going to change this. I'm going to go to year to date. Check this out. And I'm going to wait for this to populate. And while that's populating, let me show you what I mean. All right. When I say selling a put, okay, you're looking at 45 days expiration. So look, the March 15th expiration is the closest one. You're going to be selling a put 45 days, as close to 45 days you can, and you want to sell it at around 84% probability out of the money. So you look for what 84% probably out of the money is, like right around here. Let's go left. You're going to sell the 180 put for $1.34. And you're going to buy 5 strikes below it. 1, 2, 3, 4. You're going to sell this and you're going to buy this on the put side. Okay? So to do that in Thinkorswim, you just go like this, right click, sell vertical, right? It'll show 180 over here, and you count 5 strikes back, right? Or you subtract $5, which is the 175. Because 180 minus 5 is 175, right? And so you're going to sell it for 38 cents. Okay, you can, if it's not enough, you can put on more, or you can basically move your strikes up if you want to like 181 and collect more, whatever. Okay, or you can make your strikes wider, meaning instead of buying the 175, goes 10 wide, and maybe compromise, split the difference. Instead of 180, do like the 179 or something. What did I do? Well, I'm sorry, not that other way. My God. Mark, what a dumbass. Okay, you do like the not the 160, but the not the 170. Yeah, let's try the 170. So $10 wide, right? You collect more money. Whatever. The standard is 5 strikes wide, so you just stick to the 175. Okay, sometimes I get confused with though. All right, perfect. All right, and what you're doing is, I'll go back to the chart. Check it out here. When would you have done that? Well, right here on January 2nd, it got above 50. Look where the price was, right? Okay, and look what happens. Look how long it took to drop to below 50. Count the trading days. 1, 2, 3, 4, 5 trading days. Not even 4 trading days, and it got all the way down here. You would have taken your position off it. You would have made money. 50% of your max profit. You would have made money. Well, then when do you put it on again? Well, you would have put it on again. Look, right here. That's twice already in 2014. So you would have had 3 times already to put trades on. You would put it on here, right? sold it, betting it'll go higher and IV rank to drop. What happened? It went lower. IV rank shot up to like 100 or something like that, right? Doesn't matter you because you're selling this expiration date. You have until here for it to come back. And so look what happened. It got right back right here. Look, and IV rank dropped. You would have been out already. Okay, 50% of max profit. You sell again and you put on another trade. In fact, you would have been on another trade on January 27th, betting it would go higher, right? And you'd still be in that trade, correct? And you'd be expiring right here. Now, what if you have no positions on? You can put on one right now because IV rank is at 70, like I just showed you, and you'd put on a position. I can't do it on Dole right now because if I do it on Dole, because it's after hours, the freaking curve chart is not working. I don't know why. It's after hours, but oh, crap. Anyway. Here we go. Let's see if it'll work. But on this chart, you would see a curve and you see the vertical lines. But even if it doesn't work, you just go to vertical, go to short put, right? 1 standard deviation away, and hit go, and then you adjust it. You click this button right here, and you look for and move these so this says 84%. See? And then I'll just move over like this, 90, all right? Because this is all screwed up from because it's after hours. When the market's open, it'll be a lot easier. I'm just moving this up, moving this up. Oh my God, so many times I gotta move up because, you know what I mean? It'll be real fast. When the market's open, this thing shuts up. Right, look, here we go. 45 days expiration, and you're gonna move this up to, it says 84% probably out of the money, which is right around, and oh, too much. I'll zoom in though. Moving right here. Here, this is what you would sell. So look, right? See, 84% probably out of money, which is about 1 standard deviation away, and the strikes are 5 wide. How can you? Oh well, not. Let's move the strikes wide. Let's move this out until that turns to 5. 3, 4, 5. There. That's it. You have 84% probably out of the money. Look what this means though. Right now, if you put this on Monday, tomorrow, you're betting the SPY will stay above $184 at the end of 47 days, which is the March expiration. Okay, that's why this is so. Basically, you're betting it'll stay above 184, which is not even on the chart. It's all the way down here. By this expiration. Oh wait, what did I say? Crap. March. Yeah, March. 45 days. By this line right here, you're betting the SPY will stay above 184, and you're a full winner. And 184 is all the way down here. That's why people do it. So what I want you to study if you're new is, I hope that answers your question, Jam. If you're new, I want you to go to where it says Tasty Trade Newbies. Click on that. Go to the first page where it says here, cheat sheet. Go to page 1. And if you're new, study this. I've got 2 minutes. I want to make sure you click on this. This is super important. If you're brand new, study this chart. Calls and puts. Okay, that's right here. Calls and puts, right? Bullish means you're betting it'll go higher. Bearish means you're betting it'll go down. I want you to focus on this quadrant right here. Selling a credit put spread. Why? Because in the beginning, you just want to learn. You're betting that something will go higher. You only want to do it when it's high IV rank. You have a higher probability of success. You have a lower return on success, but you have a lower return on capital because you're selling premium. So you want to sell the higher strike and you want to buy the lower strike. So this is just an example. Sell the first strike out of the money and buy the second out of the money put. So you want to sell the first, you want to sell out of the money put, and you want to buy the second one. So for example, if the stock's at 101 with $5 wide, you want to sell the 101 and buy the cheaper 95. Look, remember what we did in Doe? Oh, ergo in Doe. We sold the 184 and we bought the cheaper 179 put. So the green is where you make money and the red is where you lose money. So as long as it stays above this, that's what I mean. It's all in your favor, right? Why would you not make this bet? You can do that all day long. What Karen does, she sells 95% out of the money up here. She's selling crap around here. She's betting the SPY will stay above $161. Where is it at now? It's at 200, 199, right? She's betting it'll stay above 163 around here. And she just sells them over and over again. Okay, so I hope that helps. Pay attention to this, right? Because once you master this quadrant, you're gonna add this one, which is the flip-flop, right? You're gonna bet that something will stay below this price and above this price, and you're going to play both sides and you're going to get paid on both sides. Hope that helps.